Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of cryptocurrency tax law and the IRS. So cryptocurrency, it's not the most complicated area of tax law around. Some practitioners try to make it seem like it's overly incredibly complicated just because the underlying cryptocurrency itself, the technology and whatnot, far surpasses what most of us understand about technology, right? But from a tax perspective, it's relatively straightforward. It's continually evolving, but at a baseline perspective, the IRS treats cryptocurrency like an asset, like property. It doesn't treat it the same as currency, even though currency is in the name. So that's going to significantly impact the tax rules. We'll go over the basics in a minute. One thing to keep in mind is that enforcement is at an all-time high. For example, in the draft version of the 2020 1040, a new draft question was released regarding cryptocurrency, specifically virtual currency, and whether the individual filing the return has purchased, sold, exchanged virtual currency in the year prior. So let's go through some of the basic rules. Buying cryptocurrency is not a taxable event. You go out there, you buy some stock, you buy a house. Those are not taxable events. So let's say you go out, you buy an asset for $10,000. That's your basis. So when you sell it one day or you exchange it down the line, your basis is going to be $10,000. Same concept with cryptocurrency. 1031 rules don't apply, kind of beyond the scope of this short presentation, but just know you can use the 1031 exchange rules. Common example, person 1 has cryptocurrency for $8,500. That's the value. Person 2 has an asset for $10,000. They exchange. So the person 1 who had the cryptocurrency, it's essentially what happens is $8,500. He gave the cryptocurrency worth $8,500 to person 2. Person 2 gave him an asset worth $10,000. Well, guess what? Person 1 now has a $1,500 gain, right? When he goes or she goes to sell that down the line or exchange it, the basis is going to be $10,000 because they received something for $10,000 in exchange for something for $8,500. And so now there's a $1,500 gain. Or it's the equivalent of you have an $8,500 cryptocurrency. You sell your cryptocurrency to someone for $10,000. You made $1,500 on the deal. You have to pay capital gain on it. That's the basics when it comes to cryptocurrency and capital gain, but it's not all about capital gain. So there's selling cryptocurrency, which is capital gain. There's exchanging cryptocurrency, which is capital gain. But what happens if you receive cryptocurrency as employment or consulting? Let's say person 3 has a consulting business. One of her clients pays her in cryptocurrency. Well, that's equivalent to receiving income from the IRS perspective. So therefore, person 3 is going to report that as income. Employment taxes would be paid, etc., etc. So there's no capital gain in that scenario from the recipient because she received it for work performed, and the employer or the client would just deduct it as an expense, not as a capital gain exchange, absent some other exceptions, exclusions, and limitations. Another more common feature lately is investment funds that contain cryptocurrency. If it's an investment fund and it's generating any sort of interest, dividends, capital gains, royalties, things like that, what's being generated is generally going to be taxable as well. When it comes to the tax and reporting, generally if it's due to an exchange or a sale, it's going to go on your Schedule D as in David, along with Form 8949 for each transaction. It can get pretty heavy depending on the number of transactions. So there's various software programs you can use and integrate that with your tax software. Here's where it gets even more complicated. If you've got overseas cryptocurrency, Bitcoin, Litecoin, etc., then you have to be concerned with possible FBAR reporting, foreign bank and financial account reporting, FinCEN Form 114. There was some guidance that came out recently, but it's ambiguous at best. It doesn't really dive into the nitty-gritty of if you have actual foreign bank accounts, and in those bank accounts you may have cryptocurrency or a combination of cryptocurrency and non-cryptocurrency, for lack of a better word right now. There's also FATCA Form 8938, a concern of whether the cryptocurrency is going to be considered a specified foreign financial asset, which may be determined or evaluated depending on how it's being held, where it's being held, things like that. If you've got it in an investment fund, like a cryptocurrency fund, then of course you have the concern of if it's a PFIC, passive foreign investment company, Form 8621. If you're out of compliance for cryptocurrency, the IRS, I think it was back in 18 or early 19, said there wasn't going to be a standalone program for cryptocurrency. So generally you would use one of the approved disclosure programs, the voluntary disclosure program, the traditional voluntary disclosure program, which was updated in 2018-2019 when OVDP ended, which is used for people who cannot certify under penalty of perjury that they're non-willful. The streamlined program, streamlined domestic, streamlined offshore, there's reasonable cause and delinquency procedures. My name is Sean Golding. We have a lot of free information available on our main website, goldinglawyers.com. Thank you for your time. Enjoy the rest of your day.